Hello everyone, this is Bhavik Chokshi over here. Hope you guys are doing great, studies going good, and here we are back again. So today we will be covering the topic on foreign exchange. This is on your paper number 2, that is strategic financial management. This is applicable for both the old as well as the new syllabus. So foreign exchange, as you guys are aware, is one of the most important topics that you have in your strategic financial management. A weightage of around 15 marks for sure is coming in your main exams from foreign exchange. So this video is essentially a quick revision of all the concepts that are there in your SFM. So generally in such videos, in such revision videos, we don't really do sums or problems, but here because of the nature of this chapter, because of foreign exchange, where we need to explain, let us say, something like cancellation or money market, it is much more easier to do with problems. So we have even incorporated a few problems along with the notes. So these around 20-page notes would cover all the theory as well as the problems which are relevant from an exam perspective. Okay, so let's get started quickly. So what are we going to discuss? Well, we are going to discuss the basic terminology that is there in the chapter: bid, ask, direct quote, indirect quote, cross rates, etc. Then we would proceed to determining the exchange rate on the theories which go on the exchange rate. Let's say inflation rate, interest rate, parity, etc., purchasing power parity. Then we go to various hedging techniques like using forwards along with all its complexities, looking at cancellation, extension, early delivery, etc. for the forwards, then going to money market, then going to futures, then going to options and swaps, and then certain special cases like if there is some netting or matching required, or types of foreign currency accounts, or types of exposures, and so on. Okay, so that is generally about it that we're going to discuss. So let's get started without investing a lot more time. So this is on your foreign exchange. So first of all, we'll discuss a few basic terminologies. To start with, you have something like the spot rate, that is the rate prevailing on the date of the transaction, and forward rates, which mean rates which are going to which are expected to occur at a future date. Now, exchange rates are relative in nature, so it is a combination of two currencies, and hence they are always quoted in relative terms. So you'll have something like rupees per dollar, or euro per pound, or pound per Swiss franc, or so on. So these are always relative rates. So the way in which they are quoted is, there are two ways in which they can be quoted. There's something called as a direct quote and an indirect quote. Direct quote would refer to a quote which is per unit of the foreign currency. Direct quote refers to quote which is per unit of the foreign currency. So for example, in India, rupees per dollar, that is per unit of the foreign currency, is to be taken as a direct quote. Whereas if in India the rate is quoted as dollar per rupees, that means it is quoted as one unit of the home currency is worth how many units of the foreign currency. So that is the indirect quote. Almost every problem that you will get in your exam is going to be quoted in the form of a direct quote. That is, the quotes will be given per unit of the foreign currency. However, in cases where you find indirect quotes, it is always advisable to convert these indirect quotes into direct quotes and solve, and hence it will be a lot more easier. It is not compulsory, but it will be a lot more easier. So how do we convert the indirect quotes into direct quotes? Well, 1 upon the indirect quote will give you the direct quote. 1 upon the indirect quote. So you take the inverse of the indirect quote, that becomes the direct quote. Okay, so that is about direct and indirect quote. And then comes bid and ask. Well, what do you mean by these rates? Well, exchange rates are quoted by bankers or foreign exchange dealers in bid and ask terms. Why? Because a banker who is sitting on the counter does not know whether a person coming across wants to buy the dollars or wants to sell the dollars, and as a result the banker has to quote both the rates. So B for bid, B for buy. The banker's buying rate, banker is quoting the rate, so the banker will quote from the base of what he is buying or selling. So the B for bid, B for buy, that is a banker's buying rate, is called as a bid rate, whereas the banker's selling rate is called as the ask rate. It is important to understand that when the banker buys in the two-way transaction, the customer implicitly is selling, whereas when the banker sells, that is the ask rate, the customer is buying. Usually we evolve our thought process from the perspective of the customer, though that is not compulsory. Different professors would have a different way of teaching. I personally believe that as a student, it is much more easier for you to mold your thought from the perspective of a customer who might be an importer, exporter, borrower, lender, as the case may be. Having said that, you can always think from the banker's perspective. We would prefer to think from the customer standpoint. So for example, an importer has to pay the dollars and hence he wants to buy the dollars. So if the importer wants to buy the dollars, the banker is selling the dollars and hence the transaction happens at the ask rate. Similarly, the exporter will receive dollars, and what will he do with the dollars? He will go to the bank to sell the dollars. But when the exporter is selling, the banker is buying, and hence the banker buys at the bid rate, the banker sells at the ask rate. Importer usually transacts at the ask rate, and the exporter usually transacts at the bid rate, but that is his usual case. Currency quotations, these are given as rupees per dollar. And where we refer to the unit which is given on per. So here it is rupees per dollar. It can also be, let us say, euro 1.5 per pound, in which case the unit that is there in the denominator is called as the base currency. And all your evaluation, when you evolve your thoughts, everything, bid, ask, is all perspective of the base currency. So bid is the banker's buying rate of which currency? Of rupees or of dollars? Well, whatever is there in the base. So if it is rupees per dollar, then that is a bid rate is the banker's buying rate on the base currency, and the ask rate is the banker's selling rate on the base currency. So depending on the currency quotation, we will focus our understanding based on what is there in the base currency, what is there in the denominator. There are various ways in which it can be quoted. Rupees 50 per dollar or rupees per dollar equals to 50. A very interesting thing that I would want your attention to be diverted over here is, sometimes it is given to you this same thing. See, if this is given to you as rupees, let us say, I'll just write this, rupees, you can always have the currency symbol, rupees per dollar equals 50, you clearly understand that is $1 is worth rupees 50. However, what happens is sometimes you have been given USD INR, and what a student will implicitly do is he will do dollar and rupees equals what. So we will say USD INR is 50, that means dollar per rupees is 50. वो गलत है. And कितनी बार तो क्या होता है, because you are aware, and at final say you would be aware of how rupees and dollars work, but well, you might not be aware of how a let's say Brazilian real works with the Russian ruble, and as a result we are bound to say कि USD INR दिख रहा है, that means it is rupees per dollar. That is incorrect. Whenever the rates are given in caps, three numerical caps, it is always interpreted in the other way around. So USD INR is nothing but rupees per dollar. Sir, ये उल्टा है. हाँ, अभी क्या कर सकते हैं? If I have something with me over here, so if I actually look at, let us say, USD INR, if you Google up USD INR, which is actually dollar per rupees, you will see the rate as 73.26. That is not actually, that is rupees per dollar. On the other hand, if you actually Google up INR USD, and as you can see the other way around. You are seeing 1 rupee equals 2, and as a result the market notation is such. This is not the institute's problem. You can't blame the institute for everything that is a little difficult. This is a market convention whereby people, when they say USD INR, they actually mean rupees per dollar, and when they say INR USD, they mean the other way around. Sir, हमको exam में कैसे समझेगा? If a currency symbol is given, कोई tension नहीं. जैसे dollar symbol, rupee symbol, pound symbol, then you interpret it as it. However, if you are given in alphabets, in capital alphabets, 3-digit capital alphabets, that is when the institute also, if you look at your old practice manual as well, you will see that they inverse the rates. So USD INR is read as rupees per dollar. Be careful about this, please. Okay. After this, you have something called as cross rates. What do you mean by cross rates? Well, a lot of currencies are not directly quoted. You have frequently traded currencies like the dollar, the pound, the yen, let us say the euro. However, there are certain currencies which may not be as commonly traded, in which case you might need cross rates. What do you mean by cross rates? It means you might use some intermediate currency to reach the final currency. For example, we have taken a numerical over here to understand. So let us say you have a rupee per dollar, you then have dollar per pound, and these are all symbols given, and you have euros per pound. However, what you actually want to find is rupees per euro. Acha, now if you go to see, there are certain intermediate currencies. You want rupees, the rupees is over here, and you also want euro, and the euro is over here. Well, you have to arrange the quotes in such a way that rupees ultimately comes in the numerator. As you can see over here, rupees comes in the numerator, and the euro comes in the denominator. The euro comes in the denominator, and all the intermediate currencies cancel. So rupees per dollar. Okay, so यहाँ पे dollar denominator में है. So in the next level, you should have dollar in the numerator, and then dollar per pound. Pound denominator में है, तो यहाँ पे pound has to come in the numerator, and by that, dollar and dollar gets cancelled, pound and pound gets cancelled. Your answer remains in rupees per euro. Now, what do we need to do? Well, we need to just compare. Well, you want rupees per euro. The question also gives you rupees per euro, and hence you directly take 50. You want dollar per pound. The question also gives you dollar per pound. You directly take 1.5. But you want pound per euro. The question gives you euro per pound. तो क्या करने का? Inverse कर लेने का. We have studied that if you want to take, you have a direct quote, you want to convert to indirect, or vice versa, you just have to take the inverse, and as a result, as you can see over here, you have taken the inverse, and that gives you rupees 62.5 per euro. Fair? So this is just a numerical on the cross rates. Now, what becomes challenging is cross rates with the bid and ask. If there is bid rate and ask rate both given, and you have to do crossing, then it becomes a little challenging on what rate to take. Well, it is fairly simple. For the bid cross rate, you take bid terms for each of them. For the ask cross rate, you take ask terms. The only challenge over here is, if you have to take the inverse, and pay attention to this, if you have to take the inverse, remember the inverse of the bid rate will always give you the ask rate, and the inverse of the ask rate will give you the bid rate. Sir, aisa kyun? Well, it is a very simple mathematical property if you are aware. When you look at 2 and 3, क्या greater होता है? अपन बोलते हैं क्या सवाल है, हमारे ईगो के ऊपर आ गया. We are at final say, yes, between 2 and 3, 3 is greater. However, the moment you take an inverse, this becomes 1 by 2 and this becomes 1 by 3. And as a result, 1 by 2, that is half, is greater than 1 by 3, that is 0.33. So over here, when you look at 2, smaller rate is, remember, always the bid rate, and the higher rate. Banker buys at the cheaper rate, sells at the higher rate. The difference between the two is called as spread. And the higher rate is called as the ask rate. So when I look at the rates, let us say exchange rates being 2 and 3, 2 is the bid rate, 3 is the ask rate. The moment I take the inverse of 2, well, I get a higher rate, and hence this is the ask rate, whereas 1 by 3 is the bid rate. So this, we're just doing it very quickly so that we can cover the maximum in the amount of time that we have. So we have taken another example where you have 40 and 50. That is the dollar. Base currency is a dollar, so that is a dollar bid and dollar ask. If I take the inverse, we have given the rule that the inverse of the bid is going to give you the ask and the other way around. If I take the inverse, I can see that 40 ka inverse hota hai 0.025, which is actually a higher number as compared to 50 ka inverse, which is 0.02. And hence, if rupee is to be taken as a base currency, then you can see that the inverse of the bid, that is 40, actually gave you the ask, and the inverse of the ask actually gave you the bid. It is based on this mathematical property that we just discussed of 2 and 3. So what you have done over here is given you an example, and over here everywhere you have the cross rate. So for example, you want to find the rupee per euro bid rate. It is an extension of the example that we have earlier done. Well, what we'll do is we'll arrange the quotes in the same way. We'll arrange the quotes in the same way that rupee ultimately is in the numerator, euro is in the denominator, and all the intermediate currencies kind of cancel. So over here, it is rupee per dollar, dollar per pound, and pound per euro bid. All of these are going to be bid rates. Now, you see the exchange rate quotes. You want rupee per dollar. Well, the question also gives you the rupee per dollar rate, and hence the bid rate is the lower of the two, that is 40. You want dollar per pound, and the question also gives you dollar per pound. The lower of the two, that is 1.4, is the bid rate. You want pound per euro. The question gives you euro per pound, and hence you have to take the inverse. And at this stage, you have to remember that the inverse of, you want to take the inverse, right? But जब भी आप inverse लोगे तो inverse of ask is actually going to give you the bid. You want the bid rate, but वो bid rate आपको inverse लेके चाहिए, and as a result you'll have to take the inverse of the ask rate in order to get the bid rate, and hence here you will take 1.3 in your workings, and that is how you will get your cross rate. Are we getting this? In a similar way, you can always do this for the bid rate. You can also always do it for the ask rate. So this is a quick run up for your cross rates. Then comes a question on how are exchange rates actually determined. Okay, we understand that the rupee per dollar rate is, let us say, 70 or 75, euro is 80 or 85, pound is around 90, but who decides this exchange rate? Well, it is based on this economic theory of purchasing power parity, which means that a basket of goods has to cost the same across the world. So for example, there is no transportation cost and there are 50 pence. Let us say these 50 pence in India costed 50 rupees. And if I go to the US, those 50 pence are available at $1, which means that one green note of the dollar is capable of buying 50 pence, which same 50 notes of 1 rupee each can buy. And as a result, what $1 can buy is what 50 rupees can buy. And the parity on purchasing power is attained. That is a basket of goods. For example, pens, what $1 can buy is exactly what 50 rupees can buy. And this is based on, again, our property in school that we have studied, that if A is equal to B and if B is equal to C, then A is equal to C. So for example, if $1 equals 50 pence and 50 pence equals 50 rupees, well, by default, $1 equals 50 rupees. That is what you call as the absolute form of the purchasing power parity theory. Purchasing power parity theory it says that in absence of transaction cost, taxes, import duty, everything, all the convenient assumptions that are taken in economics, purchasing power parity theory says that a basket of goods will cost the same across the world, and that is why the exchange rate reflects the differences in purchasing power across the world. Are we getting this? So $1 can buy 50 pence, 50 rupees are needed to buy 50 pence. So we say $1 is worth rupees 50 because both of them can buy the same thing, that is 50 pence. Okay, now why should the exchange rate change? Well, a derivation of this is, well, if the exchange rate is determined based on the purchasing power, it should change if the purchasing power changes. And why does the purchasing power change? Well, it changes because of inflation. Inflation eats up your purchasing power. So for example, in US, the inflation is 0%. Then even after 1 year, those same 50 pence are going to cost $1 only. However, if in India the inflation is 10%, that means all else remaining constant, the price of those pens in India will now become 55 rupees. 10% inflation, 50 rupees plus 10%. And as a result, if you see this parity after 1 year, then you will find that $1 gives you 50 pence, but now 55 rupees give you those same 50 pence. And as a result, your exchange rates have to change in line with the changes in purchasing power, and hence we have the inflation rate parity theory, or also called as a relative form of the purchasing power parity theory. So under the inflation rate parity theory, what does happen is, we have just kind of gone through the formula. We try to estimate the F, that is we try to estimate the rate that is expected to prevail in the future. This is a future spot rate estimated, and S is the spot rate today. Now a lot of students do get confused over here कि यार चलो F by S तो हमें समझ में आया, but what are we going to take on the right hand side? Which inflation rate will come in the numerator? Which of them will come in the denominator? From an exam perspective, again, we have discussed the concept briefly about inflation rate parity, but from an exam perspective, remember what comes in a numerator and denominator is a direct function of the code that you take. So if the spot rate is rupees for 50 per dollar, then rupees in the numerator of the spot rate, rupees 50 per dollar, then rupees is in the numerator, dollar is in the denominator. That same thing comes over here, rupees in the numerator, dollar in the denominator. If your exchange rate was, for example, euro per pound, then euro will come in the numerator and pound will come in the denominator. You will directly take what is there in the exchange rate quote as the numerator and the denominator. We assume annual compounding, which means if the rates are to be found after 1 year, you raise it to n, where n reflects the number of years. However, sometimes you have to find the rates after 3 months, after 6 months, in which case there is no compounding. However, the interest rates, unless otherwise given, or inflation rates, unless otherwise given, are assumed to be percentage per annum numbers. And as a result, in case it is for a time period which is less than 1 year, then what you can do is you can take the interest rate and multiply it by m by 12, where m represents the number of months. This is what is, and we have even given the rule, this is how you predict the forward rates theoretically or the expected spot rate. Okay, now there's something called as a forward discount or a premium. What do you mean by forward premium? That means 1 unit of a currency will fetch more at a future date. What is discount? 1 unit of a currency will fetch lesser than the spot rate in at a future date. So that is what you mean by forward discount or a premium. In case of a premium, if that currency is the base currency, at a future date the value will be higher. So if it is rupees 40 per dollar and it moves up to rupees 50 per dollar, that means dollar is at a premium. For each unit of the dollar, you are getting more of rupees. And if it is 40 per dollar, now it becomes at a future date is expected to become rupees 35 per dollar. That means the dollar is at a discount. Every unit of dollar which is there in the base currency is giving you a lesser value. How do you calculate the premium or discount? Well, for example, for a rupee per dollar rate, spot is 40 and 1 year forward is 50, which means, well, the base currency which is at a dollar, which is currently at 40, is now going up to 50. So the formula is F minus S in the numerator, that is the forward rate minus the spot rate upon S. This is how you calculate the percentages actually, into 100 into 12 by M, because this is going to be quoted as a percentage per annum number. This is the premium or the discount formula for what is there in the base currency. अच्छा, what if you want to do it in the non-base currency? There is a longer way to do it. अपन क्या करेंगे, अपन हर एक चीज को वापस अभी indirect quote में लेके जाएंगे ताकि rupees now comes in the denominator and apply the same formula. Alternatively, you can apply that concept where we used to, remember in your 11th or 12th, you used to do that, well, 1/5 on sales is same as 1/4 on cost. So that same concept can be applied and a shortcut can be used, and because we are doing a revisionary thing, we are just directly discussing the shortcut, whereby you can say that on the non-base currency, whether it is a premium or a discount does not really matter. On the non-base currency, यहाँ पे तो चलो it is a discount, but it can be a premium as well. On the non-base currency, the formula will be S minus F upon F. Upon F. This is also a mathematical reason. जैसे the logic for this is when you go from 100 to 120, this is an increase of 20%. That is 120 minus 100 upon 100. However, when you go from 120 to 100, that is a fall of 20 rupees. But 20 rupees on the base of 120, higher base. तो ये 16.67% दिखता है. तो ये तो कोई जादू तो ना लग रहा है. अपन बोलते हैं ऐसे कैसे possible? It's just a mathematical application. When you move from 100 to 120, or when you calculate profit margin on cost versus profit margin on selling price, they appear to be separate margins. In a similar way, over here, in the first case, your base was taken as 40, which is the lower base. In the second case, the base is going to be taken as a higher base, and hence you will find a slightly different number. ये mathematical process है. Over here, we are just discussing the formula. Okay, then you have arbitrage. What do you mean by arbitrage? Arbitrage means riskless profit. Before, without bearing any risk, if you were to earn profit, and without making any investment, if you were to, of your own funds, if you were to make any profit, that is when it is arbitrage. Arbitrage is one of the most important reasons why a lot of financial models work, because if there is an arbitrage opportunity, a lot of people will actually try to exploit that opportunity, and demand supply pressures will ensure that the price kind of stabilizes to its equilibrium levels. So arbitrage can be of various types. There is something called as a 2-point arbitrage. What do you mean by 2-point arbitrage? For example, let us say there are markets in India and then there is a market in US. In India, the dollar is available at 50. In the US, it is available at 51. So what you can do is you can buy in the cheaper market, that is India. You can use 50 rupees, assuming there's no transaction cost, taxes, etc. You can use 50 rupees to buy $1 and sell that same $1 outside India for rupees 51 and earn 1 rupee in the process. So that is riskless profit. और जैसे आपने देखा है कितनी बार BSE and NSE पे price अलग है. Practically you also have to consider transaction cost, but ignoring that theoretically for the time being, you can buy at BSE, Bombay Stock Exchange, and sell it at the NSE if the prices are different. That is arbitrage profit, riskless. Acha, then there is covered interest arbitrage. Covered interest arbitrage is interesting. It bases its understanding on what is called as the interest rate parity theory. Now, interest rate parity theory is exactly like inflation rate parity theory, because generally inflations and interest rates go hand in hand. The countries where inflation is higher, well, interest rate is also higher. The countries where inflation is lower, the interest rates are also lower. And as a result, the covered interest arbitrage ensures that the interest rate parity theory also applies. So the formula for interest rate parity is exactly the same as inflation rate parity. We have written it over here. That is F by S equals 1 plus I upon 1 plus I. क्या लेना चाहिए? Well, if it's a rupee per dollar quote, तो rupee is a non-base currency that is in the numerator. तो इवन ये फॉर्मूला के न्यूमरेटर में रुपीस का इंटरेस्ट आएगा, डिनोमिनेटर में डॉलर का इंटरेस्ट आएगा. वी आर डूइंग इट फ्रॉम एन एग्जाम पर्सपेक्टिव राइट नाउ. Okay, so I mean, why should this theory work? Why should this formula work? Well, because if it does not work, then it opens up an arbitrage possibility which can be exploited by an arbitrager, and demand supply pressures will ensure that this works. So let us take an example for this. Let us say you take an example where the spot rate is rupees 50 per dollar and the 1 year forward rate as quoted by the bank is rupees 55. Interest rates in India are 10% and in the US are 5%. So if I were to use the interest rate parity theory, then let's say the 1 year theoretical forward, which should be as per the interest rate parity theory, should be, well, if you apply this, and this is a fairly easy calculation, you can refer that. So you have 10% India ka interest numerator mein and 5% US interest in the denominator. The rate is rupee per dollar. So the rupee interest will in the numerator, dollar interest in the denominator, and you get 52.38. Achha, the theoretical forward is rupees 52.38, but the actual forward is 55. Now you can actually transact in the market at 55. At 55, not at 52.38, it's a theoretical number. So we will say that, well, 55 seems to be overvalued. Its real value is 52.38, but in the market it is 55, and hence it is preferable to use that forward opportunity to sell. Why? Because you sell overvalued assets. You sell the overvalued item. It is at 55, whereas the theoretical value is only 52. And hence you will sell the forward. Achha, if you sell the forward, theoretically, you are arbitrager, which means you have nothing to start with. You start at 0 and you end up with a number greater than 0. Then what will you say? We say, yaar, agar hame ultimately dollar sell karna hai, तो sell करने के लिए we need to have dollar with us, and hence what you want to do now is you want to buy the dollars. I will again repeat, ultimately you want to sell dollars. Forward में you want to sell dollars. 1 year later you want to sell dollars, but dollar आएगा कहाँ से? आप तो arbitrager, you have nothing to start with, and hence you want to buy dollars today. But for buying dollars you need rupees. Now you don't want to invest your own rupees because you are an arbitrager. You don't want to invest. Investment भी नहीं, उसके अलावा हमें profit चाहिए. So what you will do is you will borrow rupees and use that rupees to buy the dollars. You will use those rupees to buy the dollars at the spot rate. If you are borrowing, India में आपको borrowing interest rate लगेगा, and in the US you will deposit those dollars and you will earn income. Okay, so let us try to see what happens over here. If, I mean, I've just tried to prepare the chart. We have said that let us say we borrow 10,000 rupees. It can be any number, but let us say you borrow 10,000 rupees and you convert them at the spot rate, which is rupees 50 per dollar as given in the question, which means you will have $200. If you have borrowed, you will have to pay interest, and if you have converted it into dollars and deposited that, you will earn interest. So over here, the maturity of investment will be $210 after 1 year, and the repayment of loan will be 11,000 rupees. अभी loan repay करने को पैसा कहाँ से आएगा? Well, we are worried कि एक साल बाद $210, how much rate we don't know. We don't care because we can transact at the actual futures, at the actual forward rate, which is rupees 55 per dollar, and 210 into rupees 55 will give us 11,550. And hence the difference between the two is taken as an arbitrage gain. So if there is such an arbitrage gain, this is riskless. Without making any investment, we are earning this profit. If there is such an arbitrage gain, what will happen is this will attract arbitrages into the market, and more people will prefer to sell the forward contract. Demand supply, if supply increases, in which case the price falls, and hence वो 55 से fall होते जाएगा till the time it reaches 52.38, and that is the theoretical price, and hence the interest rate parity theory holds true. There is also another effect called as the international Fisher effect, where they try to study the premium. They say that the differential between the spot and the forward will also equal the differential between the interest rates. It is based on these theories only, the purchasing power and the interest rate parity theory. Okay, over here we have to have an important rule in our mind on the weakening or strengthening of currency. So remember that depending on the inflation rate or interest rates, I'll again repeat, depending on the inflation rate and interest rates, the countries which have a higher inflation rate or a higher interest rate by default will have a weaker currency. And the countries which have a lower inflation rate or a lower interest rate by default will have a stronger currency. You can apply that in the interest rate parity theory. Well, because if my country has a higher inflation rate, my purchasing power weakens, which means $1 can still buy 50 pence. For me, I will need 55 rupees to buy those 50 pence, and hence my currency is weakening. I have a higher inflation as compared to the US, my currency is weakening. Are we getting this? Okay, so just remember these rules. Okay, then you have a few hedging strategies. Hedging strategies can be for forwards. the most easiest, then the money market, then futures, options and swaps. So let us do one by one. Forwards. Well, forward hedging for an importer or a borrower. What does an importer or borrower need to do? An importer or borrower has to repay money. And if it has to repay the money, it has to buy the dollars. It needs to pay the dollars to someone, and hence it will go to the bank to buy the dollars. Well, if the customer, that is the importer, wants to buy the dollars, the banker is selling dollar, and hence the transaction usually happens at the ask rate. So here, if the direct quotes are given in the question, we will directly say that we are going to buy the dollars, and if we are buying, the banker is selling. The banker usually sells at the ask rate. However, if the indirect quotes are given, it is advisable to convert them first into direct quotes and then apply the same rule. You will still buy, but this is after you convert it into direct quotes. Similarly, if it is an exporter or a lender, an exporter is going to receive the foreign currency. What he would do is he would sell that foreign currency to the bank, and as a result, the bank is going to buy it. The banker buys at the bid rate, and the customer sells, basically, that is the banker buys, and the banker buys at the bid rate. Again, if the rates are given in indirect quotes, you will first convert them into direct quotes by taking inverse and then apply this bid and ask. It is one of the most important things to do over here. Generally, if you are stuck somewhere, just remember exam mein pressure aa jata hai and you kind of get stuck. You can't really determine ke bid hai ya ask ke kaun sa rate lena chahiye. Do a trial and error method if you are stuck. Ideally, I don't recommend that. You should do it conceptually, but if you are stuck and you are unable to determine between the two rates, do the trial and error, which means if you have to pay money, the rate which results in a higher payment will always be selected, and if you are going to receive the money, the rate which results in a lower receipt is always going to be selected. Remember, as a customer, you will always enter into a losing position. If you have to buy, then you have to pay more. If you're going to sell, you're going to get less in your hand. This is how the foreign exchange market works. There is, in certain questions, you might have an exchange margin given, and it might be given that exchange margin is 0.1% on the buying rate and 0.2% on the selling rate. Now you might be confused, ke buying and selling kiska? It is always the buying and selling of the banker. It is always the buying and selling of the banker. So when the bank, if let us say the exchange margin is 0.1% on the buying rate, it is, remember, on the banker's buying rate. So when the exporter sells, the banker buys. When the exporter sells, the banker buys, right? Okay, if the banker is buying, the question also arises that the exchange margin should be added or subtracted. Well, it depends. Again, the same rule applies. The exchange margin is the cost for the customer, and as a result, it will result in a higher cost. So if it is an importer के रेट के ऊपर वो ऐड होएगा ताकि उसका कॉस्ट बढ़ेगा. Whereas it is an exporter के लिए कैश इनफ्लो है, it will be subtracted. So as you can see over here, for an exporter, you will deduct from the agreed rate so that your cash inflow is lower, because that is a charge of the bank, whereas for an importer, you will add it to the agreed rate. So this is again based on the buying and selling rate of the banker. Then there are certain questions where you might be given swap points. What are swap points? Well, if you see questions like this, you might be given spot rate is 50.1234 and 51.5678. So this is like the bid and the ask rate, and then you might be given 1 month points as 25 and 35. Are 25 and 35 ka kya karne ka? Well, there are certain rules that you have to remember. Again, this is based on market convention, that if the swap points are given in the ascending order, you will add to the spot rate in order to get the forward rate. If the swap points are given in the descending order, you will deduct from the spot rate in order to get the forward rate. ये illogical आपको लगता है या फिर ऐसा guesswork लगता है? It is not guesswork, it is quite logical in the sense that if the swap points are given in the ascending order, and remember, a banker has more risk when he deals in the forward market as compared to the spot market, and hence he will do that only if he gets a higher profit. That is when the spread increases. Spread is the difference between bid and ask. So if the points are given in the ascending order and you are adding them, the spread will widen. But if they are in descending order and you add them, the spread will narrow, which is illogical, because a banker will never enter into a forward market if it is getting a lower compensation. उससे अच्छा बोलेगा forward में तो risk है ना यार, spot में उससे अच्छा मैं deal करूं. And hence you deduct when the points are given in descending order, you deduct, and you will always find that when you deduct, the spread widens. The bid falls more, the ask falls less, the spread widens, which is logical, and hence this is correct. अगर आपको याद रहता है तो ठीक है, otherwise just remember this rule. A for ascending, A for add, D for descending, D for deduct. So over here, this is given in ascending order. तो हमने क्या किया, उसको add किया. The bid points to be added to the bid rate, whereas the ask points are to be added to the ask rate. अच्छा, बट अभी वो तो 25 and 30 किया, तो क्या हमें 50 plus 25 that is 75 कर देना? नहीं. The points are to be restated in decimals, and when you are restating it in decimals, remember this is based on the number of decimals in the exchange rate code. If the exchange rate code has 4 decimals, and 25 represents 0.0025. If the exchange rate code had 3 decimals, it represents 0.025. It has 2 decimals, it represents 0.25, and so on. So over here, because it had 4 codes, अपन ने बोले 25 represents 0.0025 and 35 represents 0.0035. It is given in ascending order. You have added, and that gives you the forward rate to be used in your problems. Are we getting this? This is if swap points are given. Now there is this fairly complex topic of fate of forwards. Well, fate of forwards means what happens with forward. In usual case, the forward is settled, in which case there is no problem. Your cash outflow or inflow has been agreed. However, what if you demand cancellation? What if you demand extension? What if you demand early delivery? Acha, what if you demand cancellation? Remember, forward contracts are over the counter contracts, which means it is a one-to-one contract with the bank. It is not dealt on the stock exchange. So you can't just go and buy and sell on the stock exchange, call up your broker. No, that does not happen. And hence you have to enter, if you have to cancel forward contract, for example, you are an importer and you want to cancel the forward contract, so either you go to the bank and beg for a cancellation, or you enter into what is called as a reverse forward. What do you mean by a reverse forward? It means you enter into an offsetting position. Okay, you had entered into on 1st of January, you had entered into a contract to buy $1,000 on 31st March. Abhi, let us say on 1st of February you want to cancel the contract, in which case अभी बैंकर बोलेगा हम कैंसिल नहीं करेंगे, तो अपन बोलेंगे क्या करना है, 31st मार्च को हमारे हाथ में $1,000 आएगा, वी विल रिसीव $1,000 बिकॉज वी हैव एंटर्ड इनटू अ फॉरवर्ड बाय कॉन्ट्रैक्ट, वील पे रुपीस, बट हाथ में डॉलर आएगा. हम तो रहे देसी आदमी, वी आर इंडियंस, वी डोंट रियली डू एनीथिंग विद द डॉलर्स. हमारा कॉन्ट्रैक्ट मे बी द इंपोर्ट ऑर्डर गॉट कैंसल्ड, एंड हेंस in order to offset that position, I will enter into a forward sale contract, which also matures, by the way, on 31st March. So on 31st March, I will receive $1,000 and I will give up those $1,000 and receive rupees. And that way, my risk of my forward contract is, or foreign currency is kind of mitigated. So if you look at cancellation, cancellation happens by what is called as a reverse forward method. In case of a reverse forward method, you will enter into an offsetting, which means opposite. An original buy contract offsetted by sell, an original sell contract offsetted by buy for the balance unexpired period. What if the cancellation were to happen on the last day? Well, then the balance unexpired period is 0 days, and hence the cancellation will happen at the spot rate. So if the cancellation is on the due date, then the offsetting spot rate. However, if the cancellation is before the due date, then the offsetting forward rate. So for the balance unexpired period, so if 1 month has passed, 2 months are remaining, then for the remaining 2 months, so that we get the settlement happens on the same day. So on 1st of January, customer has entered into a 3-month forward buy contract. Customer has entered for $1,000 at the rate of ₹50. So that is your CP, cost price. It is a customer's buy contract, cost price. On 1st February, that is 1 month later, the customer intends to cancel when the rates are 51 and 52 in the spot market. But वो तो आज के लिए है, हमें तो आज डॉलर मिलने ही नहीं वाले. We are going to get dollars 2 months later. That is on 31st March. We are on 1st February. When the rates are going to be 54 and 55. Acha. Now, a buy contract by the customer will be cancelled through a sell contract. Acha. When the customer sells, the banker is going to buy, and hence the transaction is going to be reflected at the bid rate. So over here, this is going to be the rate that you are going to select, 54 rupees. Acha. So original contract was the customer buying. The contract now is the customer selling at 54 as we have decided. This is your SP. SP is the selling price. Gain or loss कैसे calculate करना है? वैसे जैसे आप स्कूल में करते हैं, selling price minus cost price. That is 54 minus 50 into $1,000. If the number is positive, it is a gain. If it is negative, it is a loss. And that comes to 4,000. अच्छा, extension क्या है? Extension is just nothing but cancellation plus the new forward rate. So it is nothing but cancellation plus the new forward rate. Acha, then there is early delivery and late extension. I've written quite a few things about early delivery. Late extension, I intend to probably make a separate video for this, but we'll do this probably at the later part of the video, because this is something which is fairly complex and has the potential to confuse you more. So probably we'll do it at a later part of the video. You can refer this in line as well, but let us first finish the other part. So this is your extension. What happens in case of an extension? You will cancel. Extension means you will cancel it in the usual way, on due date or before due date, and then enter into a new contract. So instead of 31st March, if you want on 30th of April, and if the cancellation is happening on 1st February, so you want to extend, then you cancel the original contract and then enter into a fresh contract which matures on 30th of April. So it is cancellation, extension is nothing but cancellation plus a new forward contract. Early delivery, we will do it probably at the later part of the video, and for late extension, probably I'll try to make a separate video as well. Okay, then you go to money market. This is the second method of hedging. What do you mean by money market transaction? Well, in case of a money market transaction, actually speaking, you exploit the theoretical forward rate. Abhi kya ho jayega? If you are just hedging using forwards, you are at the mercy of the bank. Bank can quote any rate. Ab bolte ho barabar nahi, bank bolta hai lene ka to le, varna chalte chalo. So we will use the rates prevailing in the money market, the short term interest rates, and actually try to create our hedge position directly. Acha, to ye kaise karenge? Well, the rule is, if you are an importer and you don't want to go to the bank and enter into a forward directly, you will create a position whereby your risk is mitigated. And how is your risk mitigated? Well, if you are an importer needs to pay the dollars. I will again repeat, an importer needs to pay the dollars. Acha, if the importer is paying the dollars, that means he has a liability in the foreign currency. In order to hedge the risk, he has to create an asset in the foreign currency. That is, he has to make an investment in the foreign currency. Achha, but if he is investing in the foreign currency, that means he has to borrow money in the local currency. So over here, the thought process is that importer will borrow in the local currency based on what we have just discussed. For example, an importer has to pay $1,000 after 3 months and the spot rate is 50. I've just given a chart based explanation. Actually, exam map statement wise karoge. Interest rates in India is 12%, in US is 6%, which means now to the supplier, if I go to see in the chart, I have to pay $1,000, which means I have a liability to pay dollars that can be hedged by creating an asset in dollars, which means you have to make an investment. Kitna karege investment? $1,000? No. You will invest in such a way that after, let us say, 3 months, you are left with $1,000. Ye investment hum kidhar kar rahe? US mein kar rahe. So let us say the amount invested is 100. In which case the interest in the US is 6% per annum. That is, let us say 1.5% for 3 months. So 100 plus 1.5 will give you 101.5. And hence we say that dekho ye 101.5 hai investment. So your investment is 100 plus 1.5 interest, and hence total is 101.5. So if 101.5 is $1,000, then 100 is how much? 1.5 is how much? And you can find 985 and 15. Acha, once you want to convert, we will say 985 invest करने के लिए आज हमें rupees borrow करने पड़ेगा, but how many rupees? Well, depends on the spot rate. Let us say the spot rate is 50. So for investing 985, you will have to borrow 49,255. Which if you are borrowing, you will have to pay interest at the rate of 12% per annum. That is 3% for 3 months, and hence that is 1478 of interest. So what will happen is at the end of 3 months, you will be left with 50,728 of 50,728 of let us say cash, and this is what will be your cash outflow, and $1,000 is what you are paying. अच्छा, so sir, हमने कौन से rate पे effectively transact किया? Well, we have effectively transacted, if you go to see, at the theoretical forward rate. If I were to go to see, F upon S equals 1 plus, अच्छा, rate is given in rupees per dollar, तो numerator में rupee का rate रहेगा, that is 0.12 into 3 months है, तो into 3 by 12 upon 1 plus 0.06 into again 3 by 12. अच्छा, ये S है, तो S आपका 50 per dollar आएगा, and hence if I were to multiply this, it's a little so ये कैसे दिखेगा? F is equal to 50 into 12 into 0.12 into 3 by 12, that's 0.0. This is 1.03 upon 1.015 So this is 50 into 1.03 upon 1.015. That is 50.73, and if you go to see, this is exactly that same number, $1,000 into 50.7389, and you are getting almost that same number. So the transaction effectively gets done at the theoretical forward rate under money market. Acha, exporter hai to kya karne ka? The thought process goes something like this. An exporter has a liability, exporter has an asset, a receivable in the foreign currency, and hence in order to mitigate that, he has to create a liability so that he can use the money that he receives to pay off a liability. And hence I will borrow in dollars. Over here, if I borrow in dollars, what am I going to do? Well, I will convert that money into rupees and deposit it in rupees. So how much am I going to get after 3 months is my cash inflow under money market operations. If you do not want to think through all of this, the general rules are: importer borrows in the local currency, whereas the exporter borrows in the foreign currency. This is the thumb rule. Okay, then you go to futures hedging. This is probably one of the most complex hedgings that you have, and different professors again have different ways in which they do it. Generally, I prefer to solve this over 4 steps. First step, you determine the strategy, which means, like in case of a forward, if I'm an importer, I would want to buy the dollars. Over here also, I want to buy the futures. What is the difference between a forward and the future? Well, a forward is one-to-one contact with the bank. A future is exchange traded. A forward is does not have liquidity, cannot be traded. A future can very well be traded. The counterparty is the exchange over here. Forward can be customized. It is like your tailor-made shirt. You can go to the tailor and make the shirt of your exact size, whereas future is like a ready-made shirt. It comes in sizes of 40, 42, 44, etc. And as a result, futures has a lot size and an expiry date. Okay, so first of all, as a first step, I prefer that you determine the strategy in your mind very clearly. So strategy whether to buy or sell the futures contract. In the second step, you try to find a maturity. Well, maturity generally question में आपको दिया जाएगा. However, what happens is, because these are tailor-made contracts, customized contracts, you will want to select a size which fits you. And which is a size that, or maturity that fits you? It is a maturity that covers your intended horizon and goes beyond that. So for example, if your maturity is in March and you are having a February contract and a April contract, मार्च का कॉन्ट्रैक्ट होना चाहिए तो वही लेते थे. बट अगर हमारे पास फेब्रुवरी का कॉन्ट्रैक्ट है, अप्रैल का कॉन्ट्रैक्ट है, the general hedging principles will require you to take the April contract, because the February contract will expire at the end of February, and what if there are price changes, exchange rate changes in the month of March? You are not covered, and hence you should take the contract that covers your maturity and is nearest. अच्छा, अप्रैल के साथ आपको मई, जून, जुलाई, अगस्त के भी कॉन्ट्रैक्ट्स दिए जाएंगे, but they are going to be subjected to uncertainty for longer period, and hence we say that we should take the contract which is nearest. मार्च का है तो सबसे बेस्ट है, नहीं है तो अप्रैल का लेने का. Then you don't need, if April is available, you don't need the May, June, July. Remember, hedging is risk minimization, not profit maximization. So if a particular strategy minimizes risk, you will try to take that strategy. So the maturity, select the futures contract which is on or after the maturity date and the closest to the maturity date. Don't take the ones before. The number of contracts, well, you will divide the invoice value by the contract size or the lot size that is there. And if it is not matching, then you will take it to the nearest number. It can be higher or lower. Generally, you will take it to the nearest whole number. Achha, what happens on the settlement date? Well, futures are usually net settled, which means the exchange is not going to hand over the dollars directly to you. Instead, it is going to settle through a difference in prices, and as a result, if you are actually needing the foreign currency, the exchange is just going to give you the difference in price. So you'll actually have to go to the spot market and actually buy or sell, as the case may be, the currency that you desire. So that is the invoice value at the spot rate as on the date of settlement. तो अपन ने बोला hedging करने का फायदा क्या हुआ? Well, because futures contract are traded on the stock market, as a result, you might, if you have originally bought the futures contract, you can now cancel it, because now you don't need any risk protection. You can cancel it, and you can easily cancel it by calling your broker and by selling it. Or if you have sold the futures contract earlier, you can cancel it by buying it. So over here, you take SP minus CP, and we will do a problem on this where we try to discuss the difference between the selling price and the cost price into the contract size, into the number of contracts. Please do not make the mistake of taking the invoice value over here, because it is not necessary that in the futures market you have dealt on your invoice value, because the contract size might not match, and as a result you take the difference between prices into the number of dollars or the currency per contract into how many contracts you have decided, and that will together, if it is gain, it will come to be positive. If it is loss, it is going to come to negative. Again, over here at the top, if it is a cash inflow, you take it as positive. Outflow, it is negative. तो add करना चाहिए, less करना चाहिए, उसका टेंशन ही नहीं है. If it is a cash inflow, it is positive. Gain आया positive, दोनों को add करना चाहिए. Cash inflow positive, loss आया negative, दोनों को यानी loss less होगा. Cash outflow is negative. Loss आया, it increases your cash outflow, and effective loss वो भी negative है. तो दोनों cumulative होके increase हो जाएगा. Cash outflow is negative, and if there's a gain, the gain reduces your cash outflow, and hence वो gain positive दिखेगा. So it just remember this: cash outflow negative, cash inflow positive, gain positive, loss negative, which will automatically come if you are taking SP minus CP correctly. Achha, there are two scenarios that can come over here. Scenario one is when the futures contract. Scenario one is when the futures contract is in the same currency as the invoice currency. So this is the most common case. So your invoice is in dollars and the futures contract size is also in dollars. So this is the easier version, but you have to check करना पड़ेगा. For example, on 1st January, an entity imported goods worth $1040 for which payment is to be made on 20th of March. Okay. On 1st of January, you have been given various items. So you have the spot rate as 45, February futures at 48, April futures at 50, and June futures at 53. So you have 3 futures contract. Which contract that you are going to select is going to be critical over here. And on 20th of March, that is the date of settlement, you are again given the spot rate, and you have been given the April and the June futures because February futures must have already expired. Calculate the effective cash outflow. अच्छा, तो यहाँ पे अपन क्या करेंगे? First thing is strategy. Here, you as an importer want to buy the dollars. Well, in the futures contract, you would buy the dollars so that you can pay your supplier. So your strategy should be to buy the dollars. Second, you have to select the maturity. Which is the maturity that you select? Well, the maturity that covers your due date. Your due date is in March. So the April futures contract covers that. And June also covers, but it is far away. So we will select the April one. That is at ₹50. Now you want to find the number of contacts. अभी number of contacts कैसे find करेंगे? Your invoice is 1040, whereas the contact size in your futures is 100. So 1040 divided by 100 will give you 10.4 contracts. 0.4 हम नहीं deal कर सकते. It's either 10 or 11. Preferably you take to 10, which is the nearest number. So that is 10. So over your strategy is buy dollar futures. April futures at the rate 50, you are buying, and hence this is like the cost price CP. Number of contracts, this is 10.4, so you round it off to the nearest, that is 10. So the entity should buy 10 April futures at the rate of ₹50. Now on 20th of March, if you go to the exchange and say मेरे को $1000 या $1040 दो, exchange बोलेगा हम नहीं देगा, हमको तुमको सिर्फ difference in price देंगे. So if you have to pay the supplier, you have to go to the spot market and buy $1040 at the prevailing spot rate, which is I think 48 per dollar. This is the rate over here, which is 48 per dollar. However, what about the futures contract? Well, now it is no longer required. Originally, you had bought it and now you will cancel it by selling it because you don't no longer require it, and hence you will cancel it by selling it. So over here, where is this? So you will sell. Future buy contract will be settled through a future sell. Achha, you bought at I think 50, and now if you sell it, you will take the April futures price, and the April futures price is 52. So the selling price is 52. SP minus CP. If you go to C, किधर चलेगा? SP minus CP is 52 minus 50. That is positive. अच्छा, इसको क्या 1040 से multiply करेंगे? नहीं. This is the gain or loss per dollar, and in every contract there are $100 and there are 10 such contracts, and hence that is 2000 rupees. Acha, 2000 is a gain, that is by default positive, and there was a cash outflow because I'm an importer, so I have to pay rupees, and hence you can see the net amount automatically offset. So आपको ये plus minus करने का मगजमारी नहीं आएगा. The problematic scenario is scenario 2, where the futures contract, being a standardized contract, is in a different currency as compared to the invoice currency. So let us say your invoice is in dollars, whereas the futures contract is in rupees. Strange है, हाँ, but exam में आ सकता है. Institute में काफी problems है ऐसे. So over here, import of $1040, same case, one on 1st of January, payable on 20th March. The spot rate is given over here in per rupee terms. Everything is given in per rupee terms because the contract size, if you see, is in rupees. Now, एज अ स्ट्रेटेजी व्हाट डू यू डू, अपन बोलेंगे इंपोर्टर है, इंपोर्टर तो अभी भी बाय करेगा, परफेक्ट है, ही वांट्स टू बाय द डॉलर्स, बट इज योर कॉन्ट्रैक्ट दैट यू आर एंटरिंग इन द फ्यूचर्स मार्केट इन डॉलर्स? नो, योर कॉन्ट्रैक्ट इज इन रुपीस. So if on you desire to buy dollars, but remember when you are buying the dollars, at the same time on the other hand you are giving up your rupees. So buying dollars is equivalent to selling the rupees, and as a result your strategy over here should be to sell the rupee futures. Sell the rupee futures. So your strategy over here will be to sell the rupee futures. Maturity again covering, that is April and nearest. Number of contracts. Now there's a challenge that your contract size is in rupees whereas the invoice is in dollars. So you either convert the contract size into dollars or you convert the invoice into rupees. You can do either of them. Here what we have done is we have converted the invoice into equivalent rupees. Now this is where students also make a mistake. At what rate should you convert? अपन बोलते हैं invoice को convert करना है spot rate पे करेंगे, वो ठीक है अगर आप hedging नहीं करो. If you're not hedging, you convert it at the spot rate. However, here the intention of doing this entire exercise is to find how many futures contract do you want to take, and these futures contract you are actually taking at going to take at second, I've highlighted everything. These futures contract you are actually going to take at the April futures rate, and hence this is the April futures rate is a relevant rate because you are trying to find a number of contracts, and those number of contracts ultimately are going to be dealt at 0.02 per rupees, and as a result you will convert the invoice at the relevant futures rate, not at the spot rate. In order to find the equivalent value in rupees, that is 52,000, you divide it by 5,000, that is the contract size also in rupees. In order to find 10.4, that is 10 contracts. So what you will do now is you will sell the April futures at the rate $0.02 per rupees. Acha, on settlement date, what will happen? Again, you will have to go to the spot market and deal at the spot rate, that is 1040. Acha, यहाँ पे अपन into, you cannot multiply because if you multiply $0.0208, it will become dollar squared per rupees. ऐसा थोड़ी ना होता है. So what you have to do is the currencies have to get cancelled. So dollar and dollar cancel होएगा, तो यहाँ पे आपको divide करना पड़ेगा. So this dollar and this dollar kind of gets cancelled, and your answer ultimately remains in rupees. So it is around 50,000 rupees over here, rounded off. Gain or loss. अच्छा, यहाँ पे problem आ सकता because your original contract was sell contract and you will cancel it by buying. हाँ ठीक है. So you will cancel it by buying. So the rate over here is $0.0192. This is your April futures buying rate on 20th of March. So हमने already sell किया था, अभी अपन buy कर देते हैं, exposure cancelled. So this is your buying rate at $0.02. SP minus CP, that is dollar per rupees, into rupees 5,000 into 10 contracts. So into rupees 5,000 into 10 contracts, and ये process में आप देखो तो rupees and rupees cancel हो जाता है. Your answer, remember, will remain in dollars. However, ultimately you want to find your cash outflow or inflow in rupees, and hence this will have to be converted into rupees at the prevailing spot rate on 20th of March. I will again repeat, this situation will always result in your answer landing up in the foreign currency because the contract size is in rupees, so your gain or loss has to be in dollars. अगर आपको ये स्ट्राइक नहीं होता तो उतना आप अगर देखोगे, this is $0.02 per rupees minus $0.0192 per rupees, that is $0.008 per rupees into rupees 5,000. तो rupees and rupees cancel हो गया, तो आंसर आपका डॉलर में आ गया, and hence you will have to convert it into rupees at the prevailing spot rate. In certain questions, there can also be a futures margin. What do you mean by futures margin? In case of futures, you will have to give a deposit. And this deposit, remember, is not a cost. You might be confused and you say, हाँ deposit pay करना है तो खर्चा है. Deposit is refundable. At the end of the contract, if you have made a profit, वो refund हो जाएगा. If you have made a loss, उसके against adjust हो जाएगा. Then, what should you consider over there? Well, the fact that in case of a forward or money market, you don't have to pay any margin, but in the future you have to pay margin, which is by the way a deposit, but then time value of money भी तो होता है, and hence the interest cost on the margin is a relevant cost. So you'll have to consider the interest cost. The margin itself is not a cost, but the interest on that is actually a cost. बराबर? Okay. Then you go to currency options. This is as such a part of derivatives, but we'll do a quick discussion over here. Currency options can be of two types. There can be call options or there can be put options. Again, you can follow the same strategy like you did in futures. You can devise the strategy, you can decide the maturity, the number of options to be taken, and the value on settlement. The same strategy as futures can be applied over here, but there are two types of options. There is a call option and the put option. Remember, this is call or put on the amount that is there in the base currency of the exchange rate code. So call option is a right to buy, but right to buy what? Rupee per dollar. Is it right to buy rupees? Is it right to buy dollars? If it is a rupee per dollar quote, the exercise price is rupees per dollar, then that is on the base currency, that is a dollar. Call option is the right to buy the dollar. Typically an importer will use the call option because he wants to buy the foreign currency, whereas a put option is a right to buy, right to sell the base currency. Again, you need to be very careful over here, like you were in the futures, the exact same thing. So this is similar to future ट्रांजैक्शन सिर्फ सेटलमेंट यहाँ पे अलग हो सकता है. यहाँ पे फ्यूचर्स ऑप्शंस में क्या हो सकता है? इन केस ऑफ एन ऑप्शन कॉन्ट्रैक्ट you might exercise, you might not exercise as well. At both places you have to see whether the base currency or the contract currency is the same as the invoice currency. If it is same, then the question is relatively straightforward. If not, then you have to be careful. Your strategy, if you were to buy the dollars, buying dollars is equivalent to selling the rupees because the base currency is rupees. Number of contracts, you'll have to convert the invoice into equivalent currency at the futures rate, or over here the exercise price. And then when you're calculating the gain or loss at the time of settlement, you have to remember that the gain or loss will almost invariably come in the foreign currency, and hence you'll have to convert it into your local currency at the prevailing spot rate on the date of settlement. You have to be careful about that. Achha, currency swap. What do you mean by currency swap? Swap means an exchange. Why would entities enter into a swap in the first place? An entity would enter into a swap or an exchange because they might actually end up getting a better funding. For example, a company like Mahindra is well known in India. A company like Chrysler is well known in the US. Mahindra wants to expand in the US. Chrysler wants to expand in India. Mahindra can actually take a loan in the US, but it's not as well known, and hence it will be more expensive to borrow in the US. Chrysler wants to borrow in India because it wants to set up a project. For example, Jeep is a Chrysler company, wants to expand in India, and hence it wants to take a loan in India, but it's not as well known in India. So what they can actually do is, Mahindra, which is well known in India, can borrow at a cheaper rate in India, will borrow in rupees in India. Chrysler will borrow in dollars in the US at cheaper rates, and then they will swap or exchange their borrowings. Chrysler will give the equivalent dollar amount to Mahindra, and Mahindra will give the equivalent rupee amount to Chrysler. Chrysler will use those rupees to invest in a project in India. Mahindra will use those dollars to invest in a project in the US. And as per the swap agreement, they will also agree to pay the respective interest. So Mahindra, for example, will agree कि भाई ठीक है, मैं तेरे को, you are borrowing in dollars on my behalf, I will pay you for that dollar interest based on our agreed terms, and Chrysler will pay the rupee interest. So over here, this is how your currency swap is happening. So here we have just given an example where there's a company A who desires dollar funding and B desires rupee funding. However, they have agreed to a swap whereby A actually borrows in rupees though it needs dollars, and B actually borrows in dollars though it needs rupees, and then they swap or exchange. अच्छा, तो अभी इससे क्या होएगा? A lot of times questions will ask you over here that whether this swap is beneficial or not. कैसे समझ में आएगा? ये अपन यहाँ पे क्या कर रहे हैं? For example, if we take A, for A could have directly borrowed in dollars, and hence it could have paid $1,000 into, let's say, 10% is the rate of interest in dollars, that is $100 as interest. However, when it enters into a swap, it has to pay interest on the rupee loan to the bank of A. It has to pay to, let us say, B, because B has borrowed in dollars, and it will receive money from B as well as a matter of swap. So there will be three items. Two of them will be in a different currency, one of them is in a different currency. You have to convert everything into a uniform currency. And which currency would that be? Well, that is a currency in which you would generally have the interest on the desired borrowing. So if your desired borrowing was in dollars, your interest would come in dollars, and hence, let us say, you will compare this with the direct interest if I were to directly borrow in dollars. तो अपन क्या करेंगे? अपन बोलेंगे देखो, interest has to be paid to the bank of A. ये rupees में है. Interest to be received from B under the swap. ये भी rupees में B is going to give you because you have borrowed on behalf of B in rupees. So the net interest into the exchange rate, and that will give you the net interest in dollars. So you multiply or divide as the case maybe. Multiply/divide depending on the data. However, जैसे ये अपन ने भी कंसिडर कर दिया, यू आर पेइंग फॉर द रूपी लोन, B is going to compensate you, and you have to also pay B. So over here, when B is compensating you, you have taken a loan for B in rupees, so B will pay you rupees and you will have to compensate B in dollars. So यहाँ पे आपका second part आ जाएगा, B आपको देगा and you will also have to pay something to B. So over here, last part is interest paid to B under swap. B has borrowed in dollars for you, so you will pay that interest in dollars. And hence this will give you the effective cost under the swap, which you will compare with the direct borrowing and see what is more advisable. This is, we have not done a problem here. I mean, it is there in our main books, obviously you would have done that, but not done here. It's not as important. Interest rate में swap ज़्यादा important आता है, but currency में भी आ सकते हैं, तो आपको ये follow करना है. There are a few other points which are there in this chapter which I would want to discuss. One is netting and matching. What happens is, in a lot of cases you act as an importer as well as exporter. Now, rather than you taking a separate commitment for import, so import अगर आप hedge करना चाहोगे तो banker के पास आप जाओगे, that will happen at the ask rate, which is the higher rate. You will have to buy at the higher rate, and exporter आपको जो cash flows आएगा, you will have to hedge with the banker at the bid rate, the lower rate, and hence that will result in exchange rate losses. So rather than you converting everything into rupees at forward rates, you will net off, you will try to match the maturities and net off and say कि हाँ हमारा $7,000 payable है, $4,000 receivable है, so let us net and match and take the hedge only for the remaining $3,000. That way you save transaction cost. Or it can also be intergroup cash management, where your cash can be located at different geographies. You may either decide to pool all of that cash, convert it at the spot rate and get it to rupees and invest or borrow in the rupees as a case may be, or you might deposit or borrow in the respective countries and then pull it back at a later stage, depending at the forward rates, depending on what is more what is going to give you a higher cash. So this is basic netting and matching. Then there is an question in your old study material, I guess, about exposures. There are three types of exposures. There is transaction exposure, there is translation exposure, and operating exposure. What is a transaction exposure? It's a sophisticated name for gain or loss if the transaction is unhedged. That is, if you have entered into an import transaction and अपन बोलते हैं नहीं हमें hedge करना ही नहीं है, exchange rates might change and you might suffer a loss. That is the gain or loss if the transaction is unhedged. You have actually entered into a transaction where you actually have to pay money. That is called as transaction exposure. Translation exposure usually arises when you want to translate the financial statements, like a foreign subsidiary or a branch. You want to convert it. It is notional, it is in books and typically not hedged. And then is operating exposure. It's a very wide term. It's like the exposure that you are facing due to the economic environment in which you are operating. Operating exposure covers the transaction exposure plus a gain or loss due to change in demand. There's a question of Omega Limited, you might have seen, where there's a gain or loss on change in demand, which is very interesting, where we try to say that, well, even if you are pricing your products in the rupees, as long as your customers are foreign customers and the exchange rate changes, your products might be becoming more and more or less and less expensive for a foreigner. अपन क्या बोले कि भाई रुपीस में प्राइस किया तो अभी टेंशन ही नहीं टेंशन तो भी है आपको, because you might price your products in rupees, but if your buyers are foreigners, they will invariably convert your rupee selling price into euros and pounds, and if their euro, let's say your customers are in Europe, and if their euro price falls, you have not changed it, but exchange rate changes and their euro price falls, demand supply rules will tell you that they will demand more depending on the elasticity, and hence you might earn a higher profit because you have decided to operate in a foreign exchange market. अगर आप एक इंडियन कस्टमर को ही बेचते तो भले रुपी यूरो रेट कुछ भी चेंज होता था, he is not going to change its price. So you should refer to that Omega question to find the gain or loss due to a change in demand. And the last thing is, there are certain types of currency accounts. There is nostro account, that is our account with you. For example, an Indian bank having a Swiss franc account in Switzerland is a nostro account. A vostro account is your account with us. So an Indian bank having in rupees account of a Swiss bank, like let's say UBS having an account with a State Bank of India in India, and Loro account is a third party. It's a instruction to remit a foreign currency to a third party bank. There's a question which is also there. Now these are sundry questions. एक question है आपके old PM में इसके बारे में for netting and matching, for exposures, as well as types of accounts. So I've just discussed the concepts, unlike cancellation, etc., which have so many problems. Does not have as many problems. Here you have this problem which is very interesting. I think it's the last problem of your old course PM, and it is the first problem of your new course study material. The exact almost same problem with different numbers, where you have to calculate the cash position and the exchange position. What is the cash position? It is a position of the actual cash movements of your Nostro account, the actual bank balance that you see in your passbook, which will change if you actually remit the money or if you actually receive the money. And the exchange position is an overall position, which is generally read as an overbought or an oversold position, in which case this will be affected by all your purchases and sales. Maybe actual purchases of dollars or foreign currency, or even forward buys, forward sells, bills bought, bills sold, draft bought, draft sold. Still all of them will be covered. Even drafts cancelled, bills cancelled. You have to see whether a particular transaction is increasing your exchange position, whether cash is received or not is irrelevant, or is it reducing, and that is your exchange position. Barabar. Okay, so this kind of takes care. We will just go back to that one point that we had left about that early delivery. So this is probably the last thing you should refer to. Do not get too much bogged into this. It is a little complicated. I just give you general rules that we should follow. What happens is, in an early delivery, this is the one place that I would suggest that you think from the banker's perspective and not the customer's perspective. In case of an early delivery, what will happen is, let us say there is an exporter. An exporter was going to receive the dollars, and he was going to receive the dollars, let us say, after 3 months. बट 1 महीने के बाद उसको डॉलर आ गए, एंड ही वेंट टू द बैंक एंड ही सेड कि चलो यार प्लीज मेरा डिलीवरी ले लो. इन विच केस द बैंक इज गोइंग टू रिसीव द डॉलर्स एंड द बैंक विल हैव टू पे द रुपीस. At which rate will it pay? Let us say if it agrees to the early delivery, it will have to pay at the agreed forward rate. But what is the bank going to do with the dollars? Well, original जिसको बोलते हैं ना asset liability management. On 1st of January, when I originally entered into the contract, the bank might have said, okay, I'm entering into a 3-month forward contract with an exporter. The exporter will give me dollars after 3 months, and hence in the interbank market, I would have entered into another contract to sell those dollars. But वो तो अपन ने originally किया रहेगा for settlement on the due date. Now ये तो पहले ही आ गए महाशय, and hence when the dollars I receive, what will I do? I will have to sell it in the outside market. I will have to approach other banks and sell it in the interbank market now. So these dollars I will have to sell. In return, I will get rupees. So this is one transaction. However, the banks acknowledge, FEDA is the Foreign Exchange Dealers Association of India. FEDA acknowledges that in practice, foreign exchange dealers always enter into asset liability management. That is when they originally must have entered into a forward sale or a forward buy, as the case may be, from the exporter. They must have entered into a forward sale contract as well in order to protect themselves. अभी exporter बीच में आ जाता तो वो original forward sale का क्या करना पड़ेगा? उसको cancel करना पड़ेगा. And hence if it is an original forward sale, it will be cancelled by forward buy. ये position को अपन swap बोलते हैं. So this is going to be a swap. This is what we call as a swap gain or loss, which the banker will recover from the customer if it is a loss, which we will pass on to the customer if it's a gain. Apart from that, the banker was in any case going to enter into a forward contract. Forward contract है तो अपन बोलते हैं कि भाई अर्ली पैसा गया, पैसा अर्ली कुछ या नहीं रहता है. रिमेंबर इट इज टाइम वैल्यू. पीपल वुड से कि ओके $1,000 है, उसका बैंकर ने आज हमें $1,000 into 50, that is 50,000 दे दिया. अरे बट सामने आपने भी बैंकर को $1,000 दिया ना. It is wrong to say कि 50,000 के ऊपर टाइम वैल्यू करना चाहिए. गलत है. Banker is paying you 50,000 now, but you are also paying bank $1,000 ना. वो भी तो पैसा ही है. And hence we are trying to say that time value will only be on the differential amount. So we are saying that we are giving $1,000 to the bank. In return, bank is giving us 50,000. Now we know as a matter of fact that bank can sell it in the spot market today. And let us say if the bank sells it in the spot market today, bank will only get 48,000. So bank ने आपको 50,000 दिया है, but वो 50 में से 48 तो बैंक आज ही रिकवर कर सकता. And as a result, the time value will be calculated only on the 2,000. So there will be interest on the outlay or inflow. So as a step, what I suggest is you calculate 3 numbers. First is the amount at the agreed forward rate. This is actual cash movement. You will have to actually give cash to the customer. Amount at the spot rate for early delivery. Spot rate, जो customer से dollar आया रहेगा, for example in our export case, we will have to give it in the spot market. That will give us an actual cash. And third, जो original contract के लिए you must have entered into a forward in the interbank market, you will have to cancel that forward, and hence the amount for offsetting forward, there will be no cash flow sitting today for that. So these are the three ingredients which I would suggest you to do. And swap. What is swap? Swap means, for example, as an exporter, think of it this way: because of the early delivery, what is going to happen? Because of the early delivery, what is going to happen is the bank is going to receive the money and the bank is going to sell that dollars. So selling in the spot market, backed by that forward contract, you will have to buy. वो almost always opposite रहता है, and hence इसको swap बोलते हैं. As an exporter, I will spot sell. क्या spot sell करेंगे? जो early delivery पे dollars आएगा उसको spot sell करेंगे, and the original contract for which you must have entered into an offsetting contract in the interbank market, you must have original spot sell, forward sell था customer को. Sorry, ये confusing है. Exporter के पास से आपका buy था as a banker, and hence in order to protect you must have sold it. But अभी क्या करना पड़ेगा? आपको उसको negate करना पड़ेगा, and as a result you will have to enter into a buy contract. Basically this will always be opposite, and hence it is called a swap. This is the additional actions that a banker has to take because of you coming early. अगर आप जल्दी नहीं आते थे, banker did not have to sell anything in the spot market, and he did not need to touch that original contract. उसका कोई reverse forward करना नहीं पड़ा. ये दोनों चीज इसके लिए करना पड़ा because आप जल्दी आए. And hence, if there's any gain or any loss due to these actions, you will have to pay for it. If it's a loss, you will be given if there is a gain by the banker. This is called as swap loss. This is calculated as the difference between 0.2 and 3. 0.2 and 3 का difference होता है, उसको swap gain or loss बोलते हैं. And interest on outlay, well, this is the difference between 1 and 2 because these are actual cash movements on the date of early delivery into the interest rate into the time period. बराबर? अच्छा. So as a general rule, we have given the theory for importer as well as the exporter, but as a general rule, as a summary, just remember that swap gain or loss in case of an exporter is always going to enter into originally a contract to sell dollars to the bank. That is, the banker will buy from the exporter, and hence banker must have entered into an offsetting interbank transaction to sell those dollars. On the early delivery date, the exporter will give the bank dollars, the banker will have to sell it. So basically sell spot, and uska opposite रहेगा forward buy. Sell spot है, sell is the SP and buy is the CP. Importer का opposite रहेगा. Importer will have to buy. Importer के केस में bank will have to buy spot. Why? Because importer को अगर dollar देना है तो bank कहाँ से देगा? Bank को spot से buy करना पड़ेगा. So bank will have to buy the dollars in the spot market and cancel the original forward contract that it must have entered into the interbank market. So ये आपके importer and exporter के actions है. आप अगर एक chart ऐसा बना दो हमेशा तो आपको कभी problem नहीं आ सकता. Interest on outflow or inflow, if the cash inflow is greater, that is an interest income. Bank will have to pass on that income. If the cash outflow is greater, that is an interest cost. Bank will recover that cost. We have just discussed an example over here, and we'll just discuss that, and then we can that should take care of your revision. Importer entered into a 3-month forward contract on 1st of January at the rate ₹50. So this is your original contract. On 1st February, 3-month का था, वो 1st February को गया. He requests for an early delivery. The spot rate is 52 and 53, and the 2-month forward rate is 54 and 55. Interest on inflows and outlay is 10% per annum, and calculate payments or receipts for early delivery. Achha, so what will happen is, if you are an importer, on 1st of February, you will request the bank to give the dollars. Bank कहाँ से लाएगा? तो bank will have to buy the dollars from the spot market. So bank will have to enter into a spot buy, and by default, if it's a swap, तो आपको याद रखना है by default अगर आप रट भी लो तो ये forward sell आएगा. अच्छा, conceptually why sell? Because to the importer, the bank would have agreed to sell the dollars, and hence to protect itself, it would have agreed to a 3-month buy forward contract. Now that does not really arise, and as a result, you have to cancel it. तो फॉरवर्ड बाय को कैंसिल कैसे करेंगे? फॉरवर्ड सेल फॉर द रिमेनिंग अनएक्सपायर्ड पीरियड, एंड हेंस दिस इज अ स्वैप. ये आपका 0.2 आता है, ये आपका 0.3 आता है. सो स्पॉट बाय is going to be $1,000 if I'm not wrong into the spot rate, and forward sell is going to be $1,000 into the forward rate. Acha, if the rates are to be selected, if the banker is buying from the spot market, if the banker is buying, it is in the interbank market, banker is acting as a customer, it will have to buy from some other bank, and as a result, if the banker is buying, the counterparty is selling, and they will sell, let us say, at the higher rate, that is 53, into rupees 53 per dollar. And if the banker wants to cancel, the banker wants to sell, that means in the interbank market, the counterparty will buy, and hence that is going to happen at the bid rate, which is rupees 54 per dollar. Apart from that, point 1 में तो agreed transaction है. So the agreed transaction will be $1,000 into rupees 50 per dollar. And these are the three important points. So if you go to see, ये अपन ने chart बनाया, फिर 50, 53 and 54. अच्छा, the difference between 2 and 3 is the swap difference. Sell higher है, buy say, and as a result there is a gain, and that gain will be passed on to the customer. This is 1,000 gain that the banker has will have to be passed on to the customer. And interest on outlay, sitting today, the banker got 1,000 and it gave that 1,000 to the customer. In return, the banker got a cash inflow of 50,000, but it had to incur a cash outflow of 53,000, and hence 3,000 extra that goes फॉर द टाइमिंग. देखो वैसे तो 50 पे अग्री किया था, तो भले वो लॉस है तो आपका लॉस आपने अग्री किया था 50 के ऊपर, बट ये जो अग्री किया वो आपको थोड़ा जल्दी पे करना पड़ रहा है. दैट इज द प्रॉब्लम. तो कितना 50,000 जल्दी पे कर रहे हैं, नहीं 50,000 के सामने आपको $1,000 का भी तो है ना, एंड एज अ रिजल्ट यू आर हैविंग दैट 3,000 डिफरेंस. सो ओवर हियर दिस इज 53,000 minus 50,000 into 10% into 2 by 12, that is rupees 50. This is what you are paying more, and hence this is a cost, and hence the net amount to be paid by the customer. Gain है 1,000 का customer के लिए, banker is making the gain, and 50 का cost है, and hence 950 is the net amount. I hope this is clarified, but this is a slightly tricky topic. Late delivery or extension, if time permits and if possible, I would want to make a separate video for this. Is fairly tricky and complicated. It is based on a rule 8 of FEDI rules, which requires an automatic cancellation. Like bills of exchange have a grace period of 3 days. A forward contract also has a grace period of around 15 days, after which it automatically gets cancelled. So if you don't approach on the due date, if you approach even after the due date, within a 15-day period, the banker will honor your contract, and it does not automatically get cancelled on the same day. It gets cancelled if you don't approach within a period of 15 days. So this is as per FEDI rules. There is a problem also which is there in the new study material of the institute, and I think one problem in the old PM. If possible, we will do that problem as well separately. Otherwise, that should be it. We have tried to fairly touch upon the points. So obviously this will be helpful in your revision. Obviously this is not something that you read for the first time. Otherwise, foreign exchange, this is not to teach you foreign exchange. This is helping you to revise foreign exchange. So I hope this has been helpful. I've tried to cover the important points. Wish you all the very best. Do well. Do let us know if you have any queries, and take care. Bye bye.